Welcome everyone to the last panel of the day. As I noted, we are standing between you and cocktails, but we should blame it on Hooper if it goes long. I'm Trace Schmeltz. I'm a partner here at Barnes & Thornburg. I head our financial and regulatory practice group on the litigation side. So when Hooper and Knight get in trouble on the corporate side or their clients do, I come in. We've got a terrific panel today, and I'm going to start to my immediate right with Jennifer Marietta-Westberg, who's an expert at Cornerstone Research. She's been at Cornerstone for 8 years, where she's testified on a wide array of securities fraud, alleged insider trading, and corporate governance issues, among others. She spent 10 years as an economist at the SEC. I don't want to minimize all of the tasks that she performed at the SEC, but her time and tenure there culminated in a role as the Deputy Director of the Division of Economic and Risk Analysis and as the Deputy Chief Economist. She brings a wealth of valuable experience to our panel, most notably in analyzing the risks, reward, and costs of the regulations we'll be discussing today. To her right is Doug Rand, who's a Managing Director at Deloitte's National Office in DC. He spent nearly 20 years at Deloitte. For some reason left our fair city in Chicago, where he and I had offices just down the street from one another. He focuses on ESG reporting, SEC reporting, IPOs. He consults on technical SEC reporting matters. He reviews SEC filings and advises clients on transactions and interpretations of rules and reporting literature. He's got a Bachelor of Science and a Master's in accounting. To his right is Professor Amanda Rose, who's a professor of law at Vanderbilt University, where she's obtained a chair as well. I note this because I think it's important, and it probably shows you that I, as a University of Kansas grad who barely got out of law school, has a chip on her shoulder. Still, she graduated first in her class at Cal Berkeley, but she still managed to turn out to be a nice and practical and approachable lawyer despite that. She clerked on the Ninth Circuit before working for 5 years in securities litigation practice at Gibson Dunn. Professor Rose has published articles on corporate governance, shareholder litigation, and a wide array of securities topics. She's presented her scholarship around the world. She brings a font of experience in corporate and securities law and the institutional design of enforcement regimes as well. Last but not least, my dear friend, Rebecca Reilly, who is at the SEC in the enforcement division. Rebecca and I worked at Dewey and LaBeouf years and years ago. Its collapse had nothing to do with the two of us. I want to be clear on that. She, having a little bit of free time on her hands after the implosion, decided to go to London, where she worked Financial Conduct Authority in enforcement there. Then she came back and did 6 years with the New York State's Attorney General. She litigated investor protection and financial crimes there. She's been at the SEC in its Division of Enforcement in the New York Regional Office, which, you know, kind of important in the panoply of SEC offices. Unlike the ill-fated Salt Lake office, she's the Assistant Regional Director, so she's almost the top dog in that office, and I'm proud to call her a friend as well. We're gonna build on or jump off from the shareholder activist panel. The shareholder activist panel focused, at least in my mind, normatively on positive shareholder activism. There is a sort of negative shareholder activism that exists as well and is well treated in the academic literature, and that is the short-selling sort of activist that, like a Muddy Waters, that publishes a negative report, develops a negative hypothesis about a company, and then pounds the hegemony out of it in short selling. There's a recent paper by a professor, Platt, at the University of Kansas that delves into the idea, and I just touch on it briefly. that in that cadre of short sellers are people who also are outsider whistleblowers. So they have observed a trend and they are active in negative towards the trend or active about it, and may make a whistleblower report as well, which raises some questions about whistleblowing and privatization of public, public agency that we're going to touch on. But broadly, we're just going to start by talking about the whistleblower program, what it is at the SEC, and how it factors into all of this, what we're talking about shareholder engagement and shareholder activism. So with that, Rebecca, if you would talk to us a little bit about the whistleblower program. I'm gonna avoid using the word bounty, I promise today, but the whistleblower program and how it operates and what it is, why it's important.
Sure thing. Thank you, Trace, and thanks for the introduction. And I'm happy to be here. I'm sorry it's not in person. Before I dive into your question, I'll begin with the usual disclaimer that I'm sure all the SEC folks have already provided today. My comments today are provided in my official capacity as an Assistant Regional Director in the Division of Enforcement, but do not necessarily reflect the views of the Commission, the Commissioners, or members of the staff. The other caveat that I'm sure the other folks may not have given is that I'm not in the office of the whistleblower, so not a expert in that area. But yes, we do. I do know something about it. So with that said, I'll get to your question. The whistleblower program was established by Congress to incentivize whistleblowers to report specific, timely, and credible information about possible federal securities laws violations. It became effective in 2010 with the passage of the Dodd-Frank Act. And interestingly, at the same time, the CFTC also was the recipient of this whistleblower program through the Dodd-Frank Act. Generally speaking, the program authorizes the Commission to provide monetary awards to eligible individuals who come forward with high quality, credible, original information that leads to an SEC enforcement action in which over $1 million in sanction is ordered. And the awards kind of range in percentages of the amount awarded, the amount ordered in sanctions, anywhere from between 10% and 30%. So that's kind of just a general overview, but I will point out that there's a ton of information about the program on the SEC.gov website that includes reports to Congress for historical years, including the fiscal year of 2023. It includes a bunch of statistical information. There's a series of FAQs, or frequently asked questions. And there's, of course, details on how to submit a whistleblower SIP, if anybody's interested in doing that. The program is really important, I think, because enforcement can't be everywhere all the time. And so the program is yet just another tool to help combat fraud in the public markets and to protect investors and to protect the integrity of the market. So, the whistleblower programs may also motivate firms to create more robust compliance programs to detect and deter misconduct. And in fact, recognizing the value of these types of programs, folks may or may not be aware that the U.S. Department of Justice recently announced a pilot corporate whistleblower program. So I think that's a recognition of, the value of some of these programs. And our program has been, tremendously successful. I won't bore the panel and guests with a bunch of statistics, but, I may mention that in the fiscal year of 2023, the Commission awarded $600 million to 68 individual whistleblowers, which includes a one-time single award for almost $279 million, which was the largest in the program's history.
Just tells us that everyone in this room right now is engaged in the wrong. Doug, can you talk to us a little bit about what what do corporations do? What do auditors expect in light of the fact that whistleblowers exist in the world?
Sure, happy to. And I think one of the things that's interesting here is certainly if a company receives an investigation from the SEC as a result of this, there's going to be an expectation that that's shared with the auditor. They may end up receiving an information request for their work papers, but they're going to be very interested in any regulatory notices or investigations and how that impacts the financial statements and making sure that management's responding to that appropriately. And then I think before we had Dodd-Frank, even if we go back to the Sarbanes-Oxley Act, there was a requirement there that audit committees establish a hotline procedure so that they could receive information around either external or internal tips around financial reporting concerns. And so we've had that in place even before the SEC's whistleblower program. And the professional standards for an external auditor requires them to consider that program and the information that comes through that as part of their planning process and their risk assessment for a company. So you can definitely expect auditors to be asking about that internal hotline program, what information is coming through that, how has management and the audit committee responded to it. And that was actually just highlighted 2 years ago by the chief accountant at the SEC, Paul Munter. He released a statement encouraging audit firms around making sure that their risk assessment process for fraud risks was appropriate and robust. And he specifically mentioned inquiring with the audit committee chair around their hotline program and ensuring that it's more than a check the box exercise, but there's serious consideration, I would say, paid to those.
Yeah, I was at Enron after its collapse, and you all may recall Vincent and Elkins handled Sharon Watkins whistleblowing. Probably didn't handle it all that well, right? I think the lesson in all of this is a very delicate area, and if you have even an inkling that there is an opportunity of a whistleblower, the possibility of a whistleblower, you want to consult good experts. You want to be thinking about how to sit down productively with your auditors, how to map out how you're going to handle the whistleblower. It's very, very important, and it is one of those things that, if handled improperly, can lead to the kind of explosion that has sort of the negative aspect of shareholder engagement that we've been talking about, or that you can imagine at risk. Professor Rose, could you talk a little bit about how the types of awards Rebecca was talking about have impacted whistleblowing activity, and what that looks like in the world? I've alluded to it a little bit with reference to Professor Platt's article, but if you could build on that, it would be great.
Yeah, well, thank you, and thanks for the opportunity to be here. In terms of the sort of activist short sellers and how this program may relate to their activities, it's kind of hard to know. We do know that there are outside tipsters who have recovered awards under the program, and Professor Platt has some empirical and anecdotal evidence that some of those outside tipsters are activist short sellers. So we know that they've been awarded money under the program. What, of course, we don't know is whether or not that's motivated the activity in the first place, since there's obviously market incentives and profits to be made. So what, if any, kind of marginal effect has the prospect of a whistleblower award created? It's hard to say. It's interesting just to talk a little bit about that paper and some issues that it raises. To the extent that short sellers have enough of a market motivation to bring firm misconduct to light, the bounty payment from the SEC is a bit of a windfall, maybe a misallocation of government resources. That's one sort of takeaway from the paper. There's broader questions it raises about sort of the privatization of public enforcement functions, pros and cons associated with that type of approach to enforcement. I guess the last thing I would say is it's interesting when you think about the difference between inside tipsters and outside whistleblowers, the outsiders, in addition to maybe having some market-based incentives to blow the whistle, may also not face the same sort of damaging costs that an insider faces when they bring issues to light. And so the program seems particularly important for encouraging insiders to come forward, not only because they bear more costs usually, but also because they may not have the opportunity without violating insider trading laws from profiting from those disclosures in the marketplace. So just some thoughts and interesting provocative points in that paper.
Jennifer, as a former deputy chief economist at the SEC, I imagine you have some thoughts about sort of the risks and rewards of a whistleblower program and how, whether it incents outside tipsters in any way, whether that's good, bad, or indifferent. I'd love to hear your thoughts.
Sure. So, one of the things that we were talking about in preparing for this panel is there something somehow inappropriate by offering financial incentives for insiders or others to bring cases to the SEC? Does that somehow inappropriately sort of supplement the work the SEC is doing? And I do think it's important to be careful, as Amanda noted, about what are the financial incentives. Does that mean that only certain groups of people will be bringing information to the SEC, and thus there are other groups that don't have a financial incentive that they may not hear from? And that is an important question to ask. But when we look at the activity the SEC is doing, there's already a TIPS line. There's been a TIPS line for many, many years where people can bring information to the SEC. So there is that avenue. And then the SEC, within their budget, which can fluctuate dramatically depending on the political environment or just the financial environment of what's available for regulatory agencies. When I was at the SEC and continuing since then, the SEC is trying to implement programs where they conduct risk assessment. First of all, they have an exam program, as we all know. So they have boots on the ground, but they can't examine every single company or every single registrant every year, but they try to cover the landscape. To supplement that, they have quantitative programs where they use, and the SEC is very public about this, I'm not giving away any secret sauce, where they use filing information, they use other types of economic information from third-party vendors, et cetera, to try to risk assess where might the risks be higher than in other places so that they can use their resources effectively. But again, it's going to be difficult for them to cover the landscape of every single company or issue every single year. And so these avenues that are set up to supplement that seem to be potentially productive, but we have to keep in mind these incentives. That are they distorted, or do they leave out certain groups of people whose information then will not get to the SEC?
I think that's really insightful. The question I struggle with, I guess, is if the SEC had an additional $269 million to compensate just the division of enforcement lawyers, I think I would quit my current job and go work for the division. But Rebecca, doesn't that give you the tools that you need for you and your colleagues to go ferret this stuff out? Why would we pay it to an outside, an activist, right? An outside tipster?
Well, there's a couple points. I guess the first one is the statute itself doesn't really differentiate between insiders and outsiders. And so the program doesn't either, in terms of like how folks are treated. The second point is the money that is paid out through awards to the whistleblowers is, it's not like you can reallocate that to the SEC's, hiring budget. That's not legally possible. The money that we receive through the monetary sanctions, it either goes to investors or it goes to the U.S. Treasury, or and then the whistleblower program is different, and so the money that's going to the whistleblowers can't be reallocated to like hire more enforcement attorneys. That's just not kind of how it works. And then I think the other point that I wanted to just raise that's kind of come up across this conversation is the concept of like, outsourcing enforcement work. And, that seems to be, I think, inherent in in that kind of terminology or that thinking, is this concept that like enforcement staff receives a whistleblower submission, and then, like the next day we file an enforcement action and it's done and dusted. I mean, in my experience, when a whistleblower submission is received, that is just the tip of the iceberg and kind of the beginning of the investigation. I kind of liken it to, the New York subway ads where it's like, if you see something, say something. If I see like a brown paper bag on the subway, I call the NYPD, and then the NYPD does the investigation to see like what the brown paper bag is. And so this concept of like it's outsourcing enforcement investigations, I don't think that that's really accurate. So those are kind of some of the points that struck me about the article or the paper. And I think maybe one other, and I'll talk about it just because this chart is up on the screen. I think in determining the amount of the awards, it's relevant how valuable the information provided is. And so if an insider has kind of different, better like information, that's going to be more valuable than an outsider. And I think you can see from this chart that well, it's very small on my screen, but I believe that the awards to outsiders have been lower, right, than the awards, just the total dollars paid. And I think that kind of reflects the fact that maybe insiders have more information. And so maybe that just should be considered by some folks who are commentating on this topic.
So before we leave this topic, I have to, because there is the world of scholarship in this area. It goes to Professor Platt at KU, Rock Chalk Jayhawk. I had to say it, but I wanted to give him a shout out. But I appreciate the robust discussion, and that there, reasonable minds can more than disagree on this. And I didn't want to give anyone the impression that Rebecca was buying into Professor Platt's article at all. Nor is the panel endorsing. Just an interesting topic of conversation. I'll take it off the screen, Rebecca, so you don't have to keep cringing for the rest of the conversation. So I want to jump from that. One of the things that Jay covered this morning in conversation with Commissioner Ueda was Section 13. I mean, they focused on 13F, but I think 13D and G reporting and then Section 16 reporting are integral in shareholder engagement and awareness. And maybe Professor Rose, if you could, in your best professorial voice, give us a little rundown on those rules and what they mean and how they factor into our discussion.
Sure, and I think this will be familiar to most people in this audience. So with respect to 13D and 13G, this is the Williams Act early warning system that requires investors or group of investors who acquire 5% or more beneficial ownership of an issuer to publicly disclose that information, either on a 13D if they have a control intent, and 13G if they don't. These provisions were, the rules were recently amended to shorten the time period in which these filings have to occur. It used to be 10 days for 13D filings. Now it's 5 business days. For the sort of passive 13G filers, it used to be 45 days from calendar end, and now it's 45 days from quarter end. So those periods have been shortened, and that has, as I think we'll discuss, some implications potentially for the cost of activism. Section 16 reporting is for officers and directors, as well as beneficial owners of 10% or more of an issuer's securities, and that requires reporting of changes in ownership and is a mechanism that allows enforcement of the prohibition on short swing profits in Section 16B. I believe this isn't something I follow very closely, but there's some pending legislation that would extend Section 16 obligations to foreign private issuers. But obviously, again, has a little bit of a different function, but both systems, alert investors to what's happening in their company's stock.
And I think Hoop made this point earlier. I think you called it a rogue 13D. I like that. I'm trying to envision just how roguish a 13D can be, but that 13D gives you, if you are on management, right, gives you a sense of who's active and interested and out there lurking. And if you are a shareholder, right, Section 16 gives you a heads up as to how the insiders feel about their company, right? Both help, are interesting. I sort of liken it to, one if by land, two if by sea, sort of lanterns in the tower of the Old North Church, right? Jennifer, if you could talk to us, sort of cost benefit analyze these rules for us and help us think through why they matter and how they're helpful and in that sort of cost benefit world.
Sure. So I don't know how many of you have cozied up with one of the SEC's proposing releases or adopting releases, but there's the beginning portion of it that may walk through the legal basis, or maybe there's a statutory mandate for the rulemaking. Then there's this section in the back, which is the economic analysis. And I joined the commission in 2006, pre-financial crisis, and left in 2016. By the time I left, there was really a lot more structure around what was required. I'm going to use the word requirement loosely because there's a lot of technicalities around that. I don't want to get into that. But the SEC has put out a guidance around how they would do economic analysis and rulemaking. And there's a lot more structure around that and a lot more collaboration and coordination between the economists and the attorney and accountant experts within the building. So when a rule like this comes forward, there will be this section in the back that talks about what are the economic trade-offs. And so this rule is no exception, and you can really get some insights into at least the economic perspective of the commission. So here, and I have some notes about precisely what they said in that economic analysis, the efficiency of financial markets rests on material information becoming public in a timely fashion. They claim that knowledge of who is influencing control is highly material and that investors would benefit, sort of end of discussion. But they noted that quantifying benefits just is not possible for this rule, and it's actually not possible for many rules. While you can put some hard numbers to costs, when it comes to benefits, what does it mean to improve investor protection, for example? Sometimes you can measure that, but a lot of times you can't. And so this rule was no exception. But what was very apparent in this rulemaking is that they really crunched data. So they got information on when are the 13Ds filed. There's a lot of statistics because they wanted to see what will be the impact of moving to 5 days. And so they had a statistic about less than half of the 13Ds were currently filed within the 5-day period. Then they also looked at in accumulating their stakes. How often are the stakes accumulated within 5 days or not? And so there was information on that as well. And that sort of helps you understand what the cost will be, where the rule will bind, and where it will not. And the other thing that I'll note is often the economists want to start the economic analysis with what is the market failure? Now, there doesn't have to be a market failure for the SEC to promulgate a rulemaking. And I'm speaking as an economist, not as an attorney, and many of you are probably expert on this as well. But there may be rules where there is a market failure. So when the SEC proposed this rule, they talked about informational asymmetry being an issue. So there was more information in the hands of some versus others. Well, that's always going to happen, right? With the financial markets, the company, for example, has a lot more information about the company than the public will have. And they're not required to disclose every single piece of information. Particularly think about things that might reveal competitive advantages and things like that. So at the time when in the proposal, when the SEC said this will improve informational asymmetry, some commenters through the notice and comment process said, that's not really a market failure. So in the adopting release, the SEC had to respond and say, okay, true, informational asymmetry is not in and of itself a market failure, but we think that it's important. It will provide benefits to reduce that informational asymmetry sooner. And so that was a big part of the discussion in the adopting release. And so I just think this plays out nicely as an example of the commission using lots of data where they can to try to explain their position from an economic perspective, and also try to abide by the elements that are put out in their guidance for how they will conduct cost-benefit analysis.
In that, that analysis applies both the original adopting and then the amendment as well to shorten the time?
That's right. So there'll be an initial analysis in the proposing release, and then the comments will come in, and then those comments hopefully are addressed. And I can't say that I have ticked and tied whether every comment was addressed or not, but that's supposed to be the goal. And in addition, the commission in this release walked through sort of why does this matter, and talked about information leakage. That information can get out ahead of the filing, that information can advantage others who have not done the research and may inappropriately be benefiting, in the words of the commission.
Rebecca, I want to jump forward in our outline real quick. Just you and I had this conversation. I think I had made the comment that I've got, smaller clients who invest in small cap companies who the time change in the new rules, the amendments that require much quicker filing, it's kind of freaking them out. And you had a view, I think, about the importance of timely filing and the speed with which the markets moved. Can you talk about that?
Yeah, sure. I think that the speed of the filings, the timeliness of the filings is important for three reasons. I mean, first, as a matter of fairness, which we just kind of discussed, there's a imbalance of information that's available. Some of the cases that we've brought and seen over the years have involved delays of weeks, months, or even years. And kind of in today's society where the pace of the markets is very quick and the information is transmitted electronically and very quickly, there just, in my opinion, like there just isn't a reason for there to be such a gap. And so, to try and get the information to all the people faster is important as a matter of fairness. The second reason is the interconnectedness of the markets. So in this context, larger insider transactions at one company can have a spillover effect or an outsized effect on the market more generally. And that's stuff that we've seen before historically. And then finally, from an enforcement perspective, which is, kind of where my focus is, the sooner that we're able to figure out what's going on and potential misconduct, the faster we're able to investigate that and then take appropriate steps to protect investors and the integrity of the market. So from my perspective, the faster that we can get the information, the faster that everybody can get the information, the better.
With respect to shortening the timeframes for filings, Professor Rose, how might that impact activist shareholders?
Sure. And it's interesting. It's not clear to me which way the fairness argument cuts here. If we had transparency, sort of on day one of the activist acquiring the shares, and that would eliminate the potential for them, it would minimize the profit potential, and then that activity wouldn't take place in the first place. So, to the extent that you have an activist that's investing resources and time and identifying an undervalued firm and accumulating a position, and to the extent that creates social value, which I think in many cases it does, earlier disclosure cuts against that. So there's, both concerns about sort of investors in the marketplace feeling like they're on a level playing field, and how not feeling that way can have impacts in terms of participation in the market that needs to be balanced with the ability to accumulate and profit from a toehold in a company. And so that's always been the trade-off with the early warning system. Now, where exactly do you draw the line? Is 5 business days enough of a gap to allow people informed investors to profit from their efforts? Maybe it is. It's hard to measure these things, but I think that's the debate and why there was some controversy over reducing the time period.
Well, it's less likely to have the rogue 13D if it happens quickly, right? So the flip side of that, I suppose, will be on the 16 side, right? The quicker people know that insiders are taking steps, right? That's equally helpful to the market and in a different way. Talk to me, Rebecca, about how these rules are enforced, if you would.
Sure. In terms of enforcement, I think we can talk about what happened in September 2023. The commission announced charges against 6 officers, directors, and major shareholders of public companies for failing to timely report information about their transactions in the company's stock. In addition, 5 publicly traded companies were also charged as part of that for contributing to the failures by insiders or failing to report their insiders' information, their insiders' filing deficiencies. And these charges grouped together stemmed from an SEC enforcement initiative into these matters, which ultimately, with respect to these matters, in the aggregate, deprived investors of timely information of about over 90 million transactions. So these, I think, serve as a good example of how the Commission's Division of Enforcement has taken a very kind of robust approach to the enforcement of these filing deadlines. And that's because these ownership reports are super important to give investors, as we've all been talking about, the opportunity to evaluate, whether the holdings and transactions of these insiders could be indicative of the company's future prospects and other types of very material information. So, yeah, just using the cases from September 2023 as an example, I think is probably the best way to answer that question.
Well, that I know, just because I just sent an OIP off to a client, that the sweep continues. It's one of those, I think there's an SEC alumni, Foley curates an SEC alumni email trail. And that probably pops every other day with somebody saying, is anyone familiar with so-and-so in the New York office working on the sweep? So this issue is very live for SEC ongoing enforcement. It's something that investors have to take seriously, and as do corporations when it's insiders. And so maybe, Doug, you can talk a little bit about, from an audit or an internal control perspective, from what should corporations be doing and how should they be handling this?
Sure. I think, a lot of it goes back from the external audit lens to risk assessment, and we'll want to understand what's the company's approach to compliance with laws and regulations broadly. And so, want to understand how they're evolving to the extent the rules are changing. And I would just note that the PCAOB has a proposed rule on that would actually change our responsibilities around non-compliance with laws and regulations, or NOCLAR, you'll hear it referred to as. And if that were to go through as proposed, the auditors will likely be asking more questions about this and a lot of other issues to understand the company's processes.
I think NOCLAR has everybody a little bit frightened. Jay spoke on it recently. Jay is maybe one of the foremost experts in NOCLAR in the country. I'm just throwing that out there for you, buddy. But that's going to be interesting times for sure. So let's go from beneficial ownership reporting to a little sexier topic. If I may, I think you talked about salivating when talking about securities laws earlier. We're going to get sexy up here and talk about artificial intelligence disclosures. And Rebecca, what are artificial intelligence disclosures, and what is all the fuss about in this area?
Okay, so just to level set, the way I understand artificial intelligence is basically computer systems performing tasks that are historically required by human intelligence. And a vast majority of investors right now think that that's a very important thing for companies to be thinking about. There are stats out there that suggest that over 60% of investors think that this is an important business aspect for companies to pursue.
But I feel like describing it the way you just did, you just took the sex appeal right out of it. Kind of troubling, but keep going. I don't want to interrupt.
Do you want to put the sex appeal in?
At the risk of losing my position as a partner at Barnes and Thornburg, I'm gonna let you keep going.
Okay, so anyway, along with the sex appeal that I guess I undersold, comes a lot of investor interest, and with the investor interest comes a lot of risk, and the risk is as a result of companies may be incentivized to, I guess, overstate perhaps the extent to which they use AI in their businesses. They may be misleading with that, just all in an effort to maybe make some more money through investor investments. So yeah, so that is, now I'm feeling that I haven't been sexy enough with the answer, but in terms of disclosures, what we're looking for is, if a company is saying something about their AI capabilities, that is actually truthful. So, we've had cases, we've brought cases. Recently, March 2024, we announced settled charges against 2 investment advisors who made false misleading statements about their use of AI. They talked about how they use it to analyze client data. They talk about how they have, expert AI-driven forecasting, and they didn't have those capabilities according to the order. So, I think what enforcement is really concerned about is if a company is out there saying something about AI that is truthful.
And Jennifer, and I think because Rebecca hit the statistics, Doug, I'm skipping you for a second here, but Jennifer, can you just, Rebecca's talked about the concept of AI, sort of misstating your AI capabilities. You talked to us a little bit about AI washing.
Sure. And so many of you may have heard the term greenwashing, because there was a series of allegations against some companies that they may have been touting their ESG strategies or usages, and whether that was in actuality happening or not. So it's the same thing, but under the AI washing allegation type. And so I think it's just, Rebecca was describing well some of the recent cases that the SEC has been bringing, but to think about the fact that AI is a big umbrella. And so artificial intelligence can mean many different things. And some techniques under artificial intelligence have been around a decade or more. So you really need to know, what is the company saying that they're doing? Is it something, they could legitimately be talking about doing textual analysis and neural networks, and somebody might say, well, that's not all the AI I'm hearing about now, and so that's not appropriate. Well, that falls under the artificial umbrella. It's just a little bit older technology. Now you have generative AI, and so is that what they're touting? So just making sure that really understand the statements, and are they actually misleading, because that umbrella can be so large.
I think of companies in these areas, these cutting edge areas. It's a little bit like online dating, right? My online dating profile, I'd try to represent myself as looking like Jay Knight, like 6'4", super handsome, and people come in, they're like, you're washing something, my man. I don't know why it seems to be human nature that we overstate, right, our capabilities in areas. This is certainly one of them as a cutting edge areas. I tried to just bump the sex appeal up on that one a little bit. But let's move on though to the sexiest topic we'll talk about today, climate disclosure rules. And we heard, Commissioner Ueda's, I think, bias that, is the SEC meant to be in the environmental space? Is the SEC meant to be in these spaces, or are we really talking about material disclosures? Professor, why don't you build on this a little bit and talk to us about what these disclosures are and why they matter?
Sure. And just a little bit of background, although I think probably most people, again, in this room are familiar with this story here. Back in March of 2021, Commissioner Lee, when she was acting chair of the SEC, put out a request for comment on potential additional climate disclosures. A year later, a proposed rule was released. And then 2 years later and 24,000 comment letters later, we get the final adopted release, adopted 3-2 along party lines. The final rules differ in some important ways from the proposed rules. There's both a new subpart 1500 of Reg SK and a new subpart in Reg SX, which I'll let Doug talk more about. In terms of the SK requirements, there's obviously more than I'm going to go through here, but as a general overview, there's requirements for disclosures of material climate-related risks and their impacts on the company's activities to mitigate those risks, the roles of the board and management in assessing material climate-related risks, information regarding processes, to assess those risks, and so on and so forth. So quite a bit of narrative disclosure requirements. In terms of greenhouse gas emissions, there's requirements for companies to disclose Scope 1 and Scope 2 greenhouse gas emissions when material, with exceptions for certain smaller companies, a dropping of the Scope 3 requirements, which were quite controversial in the proposed rules. In terms of the accounting side, I'll leave that to the expert.
Sure, happy to talk about that. And so there's 3 broad categories that would be in the financial statements under this rule. So first of all, the financial statement effects of severe weather events subject to a 1% de minimis threshold. Then information about carbon offsets and RECs, renewable energy credits, when those are used as a material component of achieving a material target or goal on emissions reductions or another climate-related goal. And then lastly, the impact to the financial statement estimates and assumptions from severe weather events, material targets and goals, or transition plans. And I think what's interesting here is that would all be subject to both external audit and then management's internal control over financial reporting, sort of gathering that data. And that is something that's unique to the SEC's climate rule. If we look at other jurisdictions, whether it's the EU with their CSRD or California state regulations, that information all exists sort of outside the financial statements in a management report or a sustainability report. And so those disclosure components are certainly unique.
Jennifer, a lot of complexity in these rules. I know a lot of companies putting a lot of time, effort, and energy trying to be compliant. Talk us through the cost benefit analysis that was done to get us here. Because I know, at least from talking to a lot of clients, it feels like there's a lot of consensus around the cost and less consensus around the benefit.
Sure. So this is another rule where a really interesting dialogue emerged between the economic analysis and the proposing stage of the rule and commenters. So we talked about, is there a market failure? Or what's the justification for why the SEC is doing this rule? And so Commissioner Ueda mentioned this morning, is it enough to say, well, there are certain large investors, for example, who say this information is important to them? So done, that's all we need. And in his mind, he's also focused on financial materiality. So that was the dialogue that emerged around this rule between the economic analysis and some of the commenters who said, okay, in your economic analysis, you cited some studies that said the disclosures that you're calling for are material in an economic sense. You could measure, once the disclosure comes out across a large cross-section of firms, do stock prices move in a statistically significant manner? And you categorize that as materiality. And they said, you're citing to some studies, but those studies aren't really measuring the disclosures that you set out in the proposal and the stock prices. Instead, they're just measuring something sort of broader, which is ESG ratings that are reported to third-party vendors and whether there's an impact on stock prices. And so some of the commenters did a study themselves of the specific disclosures the SEC was looking at, the different scope disclosures, and whether stock prices moved. And they found they did not. And so in their mind, there was no materiality there because there was no statistically significant movements in stock prices when this information was disclosed. So it's just another way to look at all of the dialogues that are happening, not just around the legal justifications, but also on the economic side.
So I'm going to ask the panel generally, let's put on our Karnak the Magnificent hats, right? I'm probably the only one old enough to remember Johnny Carson in the room, but so put on your hat. Is this going to survive judicial review? Professor?
So if I were a betting woman, I would say no. There are a lot of legal, so right now the rules on hold is as litigation unfolds, and there are a lot of different challenges that have been brought to the rule, including constitutional challenges, its consistency with the First Amendment, its consistency with the SEC's statutory authority, and then also, cost benefit challenges under the APA. And I've had interesting conversations where people have, different perspectives on which is going to be the winning argument or the argument that the court would glom onto. My guess is that it's going to be on cost benefit grounds, because the SEC was really careful in the final rule to couch it as about financial materiality. And so I think it's hard for a court to suggest that the agency's being disingenuous about that. And it's much easier to say, well, the cost benefit analysis doesn't support that sufficiently, that this rule was properly adopted. But I don't know. It'll be interesting to watch. What are others' thoughts?
Well, as an accountant, I won't try and give a legal opinion here, but I would say that I think regardless of the outcome here, we're seeing the disclosures come out through whether it's the EU or California. And so I think companies that are exposed to those other jurisdictions are going to have to deal with the information one way or the other and how investors react to that.
And I would say, again, I think it's difficult to predict. I was at the commission when a series of rules started to be overturned those were my early years related to the economic analysis. Can definitely happen. Somebody had mentioned the proxy access rule this morning. And one of the critiques of that rule was that when the commission cited to academic studies in the economic analysis, they didn't cast a broad enough overview. So they cited to certain studies, but not others. So, that's just one aspect of which an economic analysis can get tripped up. And certainly everybody, I'm sure, will be focused on the materiality as well.
I could it would jeopardize our cocktail hour, start to get into the politics of all this and where we think that's going to come out. But I'll hold off on that, and we'll throw it open for questions. Any questions for our panelists today, this afternoon?
Do any of the panel, the SEC proposed a rule regarding disclosure of security-based swap positions, proposed rule 10b1 at the end of 2021, and opened for comment. Comments were received and closed. It was reopened for comment last summer. Does anybody have any prognostication or color to offer?
I don't, except I think that whole area of securities-based swaps, right, is one that, I just think there's a constant turmoil around swaps and swap reporting. And so, it's not unlike on the commodity side, the delay in that reporting. I think you just see,
Pretty much all sides.
yeah, I think that's right. Anybody want to throw a harder hardball than that one at us? So that was,
Let me throw out a philosophical question that often comes up in my classroom. So going back to the beneficial ownership disclosure that moved from a 10 to a 5-day deadline. Students are always curious, which investors are the SEC protecting? And so we have this study that shows 30 years of activism adds value, especially in recent periods. So if you're a long-term shareholder, moving that deadline is not going to affect your value because it's going to be revealed at day 5 or day 10. But the shareholders that would have acquired those shares on, say, day 6, maybe we're protecting them. But are those the shareholders that the SEC should protect, since those are more likely to be short-term shareholders? And on the margin, it makes activism more costly by having to disclose at day 5 than day 10. So that's just a question that often comes up in my classroom. So I'm curious if you have any thoughts on that.
No, other than I mean, I think that's a very interesting argument to be had. And I don't think the SEC necessarily touches on that specifically. And the release, although I can't claim to have memorized all of it.
Right.
But they seem to be more focused on the people who are trying to acquire control are potentially putting a lot of work and resources into acquiring that information. And if the purpose is to do so to increase market value, then that seems to be a good outcome. If people are only learning about this and trading on it through information leakage, they're not taking on the risk, right? Or spending the resources on the information acquisition, then shortening the window may cut down on that a little bit. So that seemed to be more where the focus was.
Gotcha.
Yeah.
Thank you.
and I think it's probably also commensurate with just the incredible effort across the board, whether it's FINRA or the SEC, right, to shorten all timeframes and to recognize just the dramatic speed with which everything is moving now, as I think Rebecca said earlier. Anything else?
Yes, I agree with that. So that's all I'll say. Thanks.
Thank you.
If your questions now are who makes the best old fashioned on the panel, I could wager a bet, but I think with that, let's call it a day, and thank you all for coming.